Hello everyone, this is Almitra Tankersly and this Gal Talks Credit. This is a late night scope. I literally just got in from doing a little outing this evening celebrating a very good friend of mine. It was her 40th birthday today, so we wanted to celebrate with her. She's a young buck. My name is Almitra Tankersly, and this Gal Talks Credit. I am a credit specialist here in Philadelphia, Pennsylvania. I wanted to make sure that I got on this evening because I had a few things that I wanted to address just in general, because I believe that there are so many of you who are more so on the journey of just trying to build credit for your business or just to get access to funding, whether it's to purchase a home, do a refi, buy a car, get a credit card, get a personal loan, all those things that y'all normally do. So I really needed to not go to bed with this on my conscience, because I think we do a lot of work over here at Credit Fitness, and I want to make sure that a lot of you can avoid the pitfalls, avoid the mistakes of some of the most common, I would say common sense, but it's not common sense because a lot of you are just not being taught. So I wanted to make sure I got on this evening or this morning for some of you and just letting you know what some of those 3 pitfalls are, and then I'm going to jump off. So just to kind of give you a backdrop of who I am, if you've never seen me in your entire life, I am a credit specialist who helps small business owners to obtain, get access to creative funding, whether it's for a startup, you want to expand, you want to, expand, sustain, and really just kind of do some magical things with your business. Most of the time, you will run after resources that usually are connected to your personal credit. That is a system, the personal credit, is not designed to carry anything, any activities involving your business. That is why the FICO system will penalize you for carrying high balances on your perfectly paid credit cards. Even if your credit cards are $10, $20, $30, $50,000 credit limits, the fact is that once you start spending those cards to do what you do for your business, even if you're going to pay it off or pay down, whatever the case that you may have, it's going to reflect negatively most of the time. Now, some of you know the magic pill or the case, whatever y'all want to call it. Some of you know how to play the game, and that's great. I commend you. But for those that are just getting in the game, for those that are trying to figure out what is it that you're messing up as far as your journey, or you're just kind of trying to figure out some stuff, this is an opportunity for you to just kind of put something on paper, look at it, stare at it, pray over it, say your songs over it, or whatever you do, and then say, okay, now we're going to go ahead and move forward. So so this is just that opportunity for you to do that. So 3 points, and then I'm out of here. So the first thing I want you to do is, number 1, you got to look at the credit report, and that's not a part of the 3, but I really got to make sure you guys understand. Look at your credit reports. Make sure you pull reports that actually have the correct formulas that the banks are going to use. As I've said that in prior scopes, if you haven't seen those, make sure you go and check out some of the older ones. But in reality, you got to look at the reports. I mean, I don't want you shooting from the hip. I don't want you to just do a Russian roulette and say, come on, baby, funding. Like, I really don't want you to do that. That's where you will find yourself making mistakes and getting unnecessary declines, all of which is going to be stressful, frustrating, and it's just going to really irk you through the process. So, and that's why so many people find it to be a deterrent to not, more so I guess, kind of push through the journey of building credit. So that's the first thing. Pull your credit report. If you're trying to figure out what credit report to pull, I say go to a report that can provide you with formulas 2, 4, and 5. And then that way you'll know exactly what scores are being said about you with your mortgage score, your car loan score, your tenant score, credit card score, personal installment loan scores. Like, those scores are all different. They're not all the same. And you might say, well, why isn't it that they're all not the same? Like, that's kind of ambiguous. That's annoying. Why would anyone have a system in place? Well, we live in America, okay? If you're watching from another country, great, awesome. But in the United States, We have a formula that is geared around the FICO system that breaks it down in those different categories. So if you are a person that does have some kind of credit, and let's say it's a 700, your 700 may only reflect certain things. So you may be an individual that may only have a car loan, maybe some student loans, maybe one credit card. So when it comes to your mortgage score might not be so high. Even though you have a 700 in general, depending on what formula you're looking at, and in most cases, a lot of you could be looking at the Vantage 8 or 9 score, which is the score system that is not widely used when it comes to considering funding for banking. Okay, so let's just put that out there. So if you do have a 700 credit score, it could be that your mortgage score is a lot less lower. Like mortgage score could be like a 620 or a 612. So that's how far off the scores can be if you're not going to be diligent enough to look at it and say, what are the comparisons? So that is why I'm emphasizing for you to pull your credit reports and look at them. It's okay. I know it gives you the actual like jitters in your stomach, your gut. Mind you, you're trying to figure out why you feel that way. Your gut is your second brain. It's connected. It's all connected. And that's why you feel all those little weird feelings, okay? So just get over that fact that your gut is your second brain, and when you're thinking about making some moves and kind of just sorting things out, if you're feeling nauseous, if you're feeling like you need to go to the bathroom, I get it, okay? So once you understand that there is a formula and there is a process of just starting with looking at the credit reports, that should definitely kind of set you off in the right pace. So I just want to preface my conversation by saying, look at your credit reports, okay? So the first pitfall when it comes to funding, gosh, I breathe in and exhale slowly because this is a common mistake that I keep seeing over and over and over again. And it really doesn't have anything to do with integrity or what's the other word I'm looking for? Due diligence. Like some of you are just really, you're diligent. You want the funding, you want what you want, and you have the score, and you're like, I'm ready. So the worst thing you can do is not have your plan of action in order. If you are seeking for a home, then you must seek for a mortgage first above all things. That means a vehicle does not come before the mortgage. If you get a vehicle or an auto loan prior to you purchasing or getting into a mortgage, more than likely you are not going to get a mortgage. The reason for that is if you think about, well, I don't know if this is a good example to use because so many people don't even value marriage, but a marital vow being taken the day, like your let's say today is the night before your marriage and tomorrow you're going to present your vows. Well, today is the day you got into another little relationship, little something, and then the person that you're supposed to be giving your vows to finds out about it and says, I'm going to leave you right here at the altar. No, thank you. Okay? That's kind of like what happens in a banking situation. So if you're pursuing a mortgage, you really need to solidify that relationship with the mortgage and not get into an auto loan. I use that example of marriage, but in reality, what you're doing is altering or throwing off your debt to credit ratios, as well as not giving your credit report enough time, enough history to show that you have or can make the capability of making all your payments on time for the next 90 days and or the next 6 months. So when you get into that relationship right away, you already kind of stabbed yourself in the eye, and more than likely a mortgage situation probably will not happen until maybe a few months after the vehicle has been purchased, where it allows that new debt to now reside on the credit report, because you have to keep in mind that the new debt may not show up until 60 calendar days later after the initial approval. Okay, so even though you might get approved today for the car or even a personal loan, that loan payment may not show until 60 days. In some cases, it could even be 90 days. It's really contingent on the actual, I guess, reporting date of the bank. Okay, so again, you have to make sure that you account for the actual time of that new item to show up. Now, you might say, well, what if that bank doesn't know I did it? So that's where hard inquiries come in at, and that is the reason why I believe hard inquiries exist, because if there is a bank that is considering you for a mortgage, they're going to be able to see that you've applied for something. Meaning, if that hard inquiry comes up showing that it's car loans involved, and in most cases, a lot of you are going directly to the car dealers and sitting at the desk, filling out the application. They go into the back room, they disappear for an hour or two, and more than likely, they have basically shotgunned your credit report and your social security number. And not only do you have one inquiry, but now you have a ton of inquiries because they're shopping you to different lenders and banking institutions that will work the deal in their favor more so, but it's to get you the vehicle and the financing. They're not just interested in selling you a vehicle. They want to sell you the vehicle plus financing. That's where the money is, financing. So if you are going in and shopping for that vehicle, now these hard inquiries are going to show up on the report. And if the report is showing hard inquiries, but there's no new trade line that's connected to this vehicle, that is what will make the underwriters say, okay, well, we're not going to, allow you to get that actual mortgage until we can actually see the new changes that have been added to your report come back in whatever amount of months they decide. Every bank is different. They all have their different underwriting laws and bylaws and guides and all that stuff for their particular books. So you have to keep in mind that all banks are not considered equal when it comes to underwriting. So that's the first pitfall. If you know you want a mortgage, go after the mortgage. Now we'll flip that and go for business funding. If you know you are going for business funding, don't buy a mortgage. Don't buy a mortgage. Don't go after a car loan. Don't go after any major ticketed items. And the reason is the same as that, because if you are trying to get business funding, there are going to be several banks that are looking at you to consider you for funding based on income, based on whether it's stated or actual proven income, but based on that, based on tax returns, based on debt to credit ratios, meaning they're looking at your credit report. You have some seasoned items on the report that gives them the warm and fuzzies, and they're like, yes, we want to give it to you. And then they see all these hard inquiries because you have now applied for a mortgage or a car loan or all the above, okay? Even in some cases, you may actually be in the process of using a business funding company where maybe you don't truly understand how that process worked, and you were just, all you heard was, I may be approved for 60 grand, right? So being in that position to know you're going to be approved for 60 grand, it makes you excited, but when the when the wash cycle ends and the rent cycle completes itself, you only come out with 20, okay? But in the process of trying to accomplish the goal of landing 60,000, all those hard inquiries have now been placed against your personal credit report, and it really is, I would say, pertinent to understand what type of lines of credit you're actually landing, because you might come in with a credit profile that is too thin, and that business building program that you've gotten yourself involved with didn't really give you the clear understanding that, hey, in order for you to really move forward on getting business lines, we're going to have to set you up with some more personal lines first. And with those first personal lines, of course, hard inquiries are going to be applied. And hard inquiries cannot usually be removed attached to those particular items because the items are open. The lines of credit are open. Okay? If you have hard inquiries that you did go for, or I should say that they went for to try to get you those lines of credit through the lenders and they denied you, then those hard inquiries can be challenged But you have to keep in mind that those hard inquiries are now going to be placed against you. And the same story goes that if you're trying to get more business funding or any type of funding for that matter, you have to keep in mind that those hard inquiries are going to be your devil. Okay? So put your stuff in order. That's the first pitfall to avoid. Putting your stuff in order, knowing what exactly you are going for. Don't try to mash everything in the same calendar year. And I'm saying a year because if you go after a mortgage is going to be expected for you to cool off, which is don't apply for anything for the next 12 calendar months. Pay that item on time for the next 12 calendar months. After a solid calendar year has been completed, now you can possibly move forward based on everything still being equal in regards to getting funding, income is still there, tax returns look good, and whatever else that are asking you to present yourself. And of course, making sure that you have your stuff in order so you know what the next type of funding you're trying to land after that mortgage has been set. The same goes if you reverse it. If you're doing business funding, keep in mind that business funding can land you $150,000 to $250,000 your first round. It is all contingent on how much you're presenting as stated income or whatever documents are necessary to do the underwriting. So again, if you're doing business funding, expect to cool off. Okay, that is the proper etiquette. I hear you guys. I know you're saying, oh no, I looked up online and they said that they can fund me and they can fund me and they can, okay. But the reality is, people, is that if you have applied for so many trade lines, the hard inquiries are going to show. If you find some demonic person, I'm just joking. But if you find someone that is actually able to work some sorcery to get those hard inquiry trade lines off, without shutting down your accounts, because that's usually the normal repercussions of going after hard inquiries with accounts that are open. They will usually shut the account off. And that's the end of that story. So again, you want to avoid closing accounts, so shutting down inquiries means shutting down accounts. So with that being said, the cooling off period is usually 6 months to 12 months. In most cases, it's 12 months. So if the accounts are open, you may get a response that says, hey, we're willing to give you funding, but we're going to need you to cool off for at least 12 months. Come back, and then we'll give you some more. So I don't want you to make yourself overwhelmed to think that it's just, free willy-nilly and you get it and you just do what you do. It's not. It's structure behind getting funding, and I want to make sure that you have a clear and concise understanding as to how this process works, so that way when you come in, you already know I'm going after a mortgage, or I have to land a mortgage, or I have to do my refi first and then expect to sit for a year on ice. Okay? Now, as far as reversing that and you're doing business funding, the same can happen, but it really, again, is a contingency as to what's on the report now versus what may need to be added to the report. Again, that could be a person that just has a thin file. They just need a go at getting business funding, and those lines that are established, if you are given an offer, needs to be seasoned for about 6 to 12 months. And again, it's usually the latter. They want to see 12 months of seasoning on the lines that are given to you, and then they will move to the next round of funding shortly thereafter. So that's the first pitfall to actually avoid. The second pitfall to avoid is if you're trying to get funding, if you have open lines of credit, you have to understand that everything must be paid on time. Everything must be paid on time. I'll say it again. Everything must be paid on time. Even if you made the mistake of paying late, or let's say you did make the mistake, but the banks made the mistake. banks do make mistakes. They make them all the time, okay? If you are in that particular situation where the bank has erred you in a way that you have a late now reporting as a 30-day, and in some cases you guys are catching it at the 60-day, those lates are going to stop you from moving forward on getting any type of funding regarding business funding. Okay, mortgaging is a little different. You can use credit repair tactics and all those different kinds of things. There's some other things that we will show you, as far as our secret sauces are concerned, to up the scores just to qualify. But the reality is, when you're doing business funding, the underwriters do not want to see any late payments within the last 6 to 12 months. So if you have a late that you just accrued, let's say in April of this year, you can expect to count 6 months from that date that it was recorded as a late, and then they may consider you. And remember, every bank is different. Their underwriting terms and guidelines are all different. So don't just take one bank and then make it blanket across all banks that exist, because that is not the case. It is a case-by-case situation. So with having a late, I do say, attack that late as much as you can, because your report should be accurate. I mean, it's your right under the Fair Credit Reporting Act and all the other acts that exist as a consumer. But if you're just going to allow it to sit there, then count 6 months. Okay, 6 months is the minimum. And again, contingent on what bank you're working with, they could ask that, that they want the whole late gone, period. Okay, so that is something that I would definitely say, make sure you are on your P's and your Q's with that, because that is something that can stop your entire train from moving forward in regards to getting funding. So that's the second. Now I want to do a second 2A. The second 2A would be balances. If you have cards that are open, whether the card is $1,000 limit or if it's a $100,000 limit, you want to make sure that your balances are at least at the 40% threshold of your carrying balances. So if you have a $10,000 card, you do not want to be caught at 70% or even at 50% usage of the total limit. You want to be right at 40%, and I always encourage less, way less than 30% that everyone, is taught about the carrying balances and utilization. You want to make sure that those balances can be as low as possible. It works for two good reasons. One is just that you're showing the underwriters that, hey, I'm not living off the credit here. I'm good. I'm a good steward, and I'm asking for more money, so give me a shot. That's the first thing. The second thing is, of course, if you are way below the 30%, you are now going to have points added back on. But of course, if you go over the 30%, then you are looking at losing points, whereas the goal is 680 or better as far as the actual scores that the underwriters want to see. But if you're losing valuable points just because you're at 40% usage of the total limit that's given to you, then more than likely you're going to be that person that is stuck in the 680 rather than maybe possibly a 737. Okay, so that's the difference of how you could be actually landing better interest rates. Having, I wouldn't say there's single digit rates usually in the 680s. I haven't seen that. I've seen double digits where it's like, 12% or, if we're really like getting high, I would say 17, 20%, like they can get up there if your scores are in that 600 family. So you just want to make sure you're monitoring how much of the balances you have spent. Now, I know some of you are probably saying, but yeah, I carry high balances. I'll make sure I get what you're saying. I get the whole FICO pie chart. I get that. But I'm still a 700 credit score. What you got to say about that? Huh? So what I will say about that is that they're going to tell you, we appreciate your 700 credit score, but we want you to pay your balances down. We will give you the 100,000 once you've paid your balances down to the actual 40% threshold or less. And that is what they will say to you with the straight face, maybe with a little twinkle in their eye and a little smile, okay? But they won't move forward until you've actually met those underlining rules that they put on the table. Now, you know, all banks, again, are not equal. They are not equal, and that's why a lot of underwriting can be done manually, but it really is going to be based on what that particular underwriter is willing to work with for that particular bank that they're working for. So you have to make sure you don't get angry, you don't get frustrated, you don't get so just like over the top and just, I don't think this works. Like, before you do that, just know that there's different rules to the game, and you have to know exactly what category you're playing in or whose backyard you're hanging out in before you actually get yourself all worked up and then thinking this is just the way it is, because that would be the wrong way to think and kind of move forward and say the system doesn't work. So you really want to make sure that balances are in check. If you can't get it down below 30%, at least get it to the 40% and then go from there. Now, please expect also, if you're only going to get it to the 40%, that is also going to chip away as to how much money they're going to give you. So if they were willing to give you $100,000 and you're only willing to take your balances down to the 40% carrying balances, expect them to now say, well, because of what we see as your carrying balances, we're not going to give you $100,000 anymore. We're going to more so give you $65,000. Okay? That is normal etiquette. You might find that not to be fair, but it's them doing what they do in underwriting. They want to make sure that their risk is good and making sure that they can get their monies back. So having those type of balances as far as 40% and a little bit lower than that will chisel away at the amount that they're willing to give you after the initial offer. So usually, like our clients that go through the process, they are given a pre-offer, and that usually gives them a range of, let's say, $50,000 between personal lines of credit, and that could be inclusive of personal loans and personal credit cards. And then on the other side, they may say, we're willing to give you, I don't know, $65,000 in business credit, which is usually all credit cards, and it's several credit cards that will collaboratively put $65K in your pocket. So again, if you do not get your balances down below the 40%, yes, expect both sides, personal and business, funding offers to be lessened based on how the high balances that you're carrying. So that's the normal etiquette to have. That's number 2. The third and last one that I want to talk about is having funding in your hand or being ready for funding, and because you know that you've seen offers come in your email box and they're giving you, whoever the company is, like it has nothing to do with who you're actually doing business with as far as a business funding opportunity. We're talking about these other guys that are popping in your inbox and they're like, hey, check us out too, because we see that you're searching. So we have an offer that's better than everybody. We're the bestest in the world, right? And you're like, oh, wow. And then they're giving you those teaser rates. The interest rate is like -5. And then, you're like, yes, I like -5. I don't even think they have -5. I'm just making that up. Just make you laugh. But you're excited. And they have a digital application where it says, just click here. And you click there, and then there's an application. You find yourself kind of like putting your name in, social. And you're like, should I continue? You're like talking to yourself at 1 a.m. And you're like, but who's going to know? It's just me and the computer. It's not just you and the computer. It's you, your computer, your credit report, your hard inquiries, and the lender. That's everybody that's on board right now. And if you're working with us, we will know too. So all I'm saying is that you want to stay away from those type of offers, because if you go through with that type of funding and you're in the middle of getting business funding, meaning you have an offer on the table, it could be $100,000. I don't know why I keep saying $100,000, but that's usually an average amount that we see people that we're working with get offered. So if you have this offer on the table, okay, and then you're entertaining these little side pieces, okay, some of y'all into side pieces. Another conversation for another day, but the side piece over here is all in your ear, and it's telling you, hey, apply for us, we got this, we'll send you the money in 24 hours, and you do that. Once you push send or submit, and an offer gets accepted, let's say you get the offer, whatever they were offering, that could be the difference of you now stopping all funding. You will not move forward on the offer that was given to you, because it's almost very similar to that very initial example I gave you about the marriage happening tomorrow and the vows and all that stuff, and you got into bed with something else the night before. So that's the same exact situation. Very different, because it's not anything tangible. Okay, a mortgage is tangible. The money is intangible, because it's abstract. You're just swiping cards and doing transfers and all that stuff. So you're not really feeling it, you're not really touching it, you just see a lot of transactions and stuff happening. So with funding, you have to be very, very cautious as to who you're entertaining and what, what type of program you're getting into, and then also just kind of like the whole umbrella of making sure that if you do apply for this particular product that said you were approved and you go for it, is that going to be something that gets you stuck? Okay, because it will put you in a pit, and you will be in that pit for a while. To give you a perfect example, when certain clients do go through actual funding or they're going through repair to get funding, a lot of times you can see delays that could occur on a person's profile due to what the credit bureaus are doing lately. They're slapping fraud alerts on and doing credit freezes, and no one even told them to do that, but they'll do it. And then if, let's say, you remove it and verbalize that you didn't put it on there or you want it off, they'll put it back on there still. Okay, so if you're in that limbo situation and you're becoming frustrated, and then you say, well, I'm just going to go to the common bank that I'm used to. They have my relationship. They know me by name. They give my kids lollipops. Like, if you get into that position and that mode, and you go into the bank and you apply for it and they give you an offer, that is the same applicable situation as what I was just saying. If you receive that offer, or if you put the offer out there, or I should say you put the request for them to give you an offer and it's out there and it's a hard inquiry, and then you come back and say, oh, if you have any other funding, personal and business, I'll take that too. Well, I'm sorry. That's actually going to possibly stop your process, stop our process, because you've initiated something that should not have been initiated. So how do you avoid all this stuff? I say get a coach, get a consultant who understands how this process truly works. Not just someone that says, oh, I know credit. Like, I really don't like that type of relationship. I want you to work with someone that really knows exactly what could be the pitfalls, the consequences of mistakes or errors that you can make by just happenstance, because you are just moving. You're a business owner. You're concentrating on what you normally concentrate on. So in regards to just making sure that your journey will work for you, then you should really pick someone that can tell you the real, that can be very firm, very strong, and not adamant to tell you the truths, okay? Not to just get your business and get you funding and they make a commission and all that. I'm talking about making sure that you can actually get the information, the truths about what you're doing or going to get yourself into if you move forward on A, B, C, and D, okay? And that is because they're going to still be with you 6 months, 12 months afterwards, so you can get more funding. So I just want you to make sure that when you are getting into these business funding programs or these business funding opportunities, whether it be a merchant cash advancement, whether it be hard money, whatever the case, you want to make sure that you are able to put yourself in a position to actually keep getting funding. And since I mentioned hard money, and I'll close on this, hard money is normally used for those wonderful real estate transactions that you can, pick up properties and opportunities and not have to go through the regular conventional way of getting a mortgage. I've been told, conventional mortgaging will always outbeat hard money. You're right. But there are several hard money situations out there, and they're not all equal. So if you are in business funding mode, meaning you're trying to get funding for your EIN without having to use your personal guarantee going forward, please note that hard money can actually place hard inquiries against you. And in some cases, they will place the item on your report, which then now changes your whole debt to income ratio, and it's putting you right back in the same situations that I just mentioned prior to me talking about hard money. So hard money, even though you are getting lines of credit or, getting access to working capital to acquire properties, to rehab it and do all those wonderful things such as carrying it too, you have to consider if that's the correct product for you instead of just being excited that somebody's willing to approve you for something, okay? There are hard money lenders that will only finance in the company name. They may place a hard inquiry. They usually should place a hard inquiry against your personal credit report, but the actual trade line only shows up on the company's business credit profile, which is a good perk, because that way the hard inquiry that's placed against your personal credit report, that can actually be challenged through credit repair, and that will be the reason why that works together. Like, that will be a coming together moment, and you'll be able to still get funding, because that's the main key. That's where the party starts, getting funding. So that's all I wanted to talk about. I wanted to give you those 3 points. I really feel better now that I can go to sleep peacefully after celebrating a cute little birthday with my friend. And yeah, man, I had to talk about it because I know you guys get frustrated. I know the process is annoying. I know that you just want what you want when you want it, but you have to understand there is an order to a lot of this funding. And if you're not aware or you're not going to be diligent enough to follow through, you will find yourself prolonging the journey to the tune of a year or 2 years because you made that mistake. So to avoid the pitfalls that I just talked about, just take heed to them. I promise you the journey will be a lot easier. Of course, I'm giving you generalized information. If you have a specific situation, it always makes sense to just reach out to us or to another professional that you feel comfortable with to go over what your specifics are on your report, so that way there's no fluff and you can say, can I move forward in funding? Should I get into this mortgage, or should I put this on hold and do this later? Like, you want to ask those real questions so that way you can make yourself happy, your health will thank you for it, your family probably will thank you for it, and so will your pockets. Alright guys, so that's all I wanted to talk about. If you're looking for an opportunity to talk to me for 30 minutes, our promo is still running. You can find it at enforcedaccuracy.com. That's 30 minutes with me. enforcedaccuracy.com. Use the link in the bio. And if you are and have not done it yet, go to creditfitness.co, join the Credit Fitness Club. It's for free, and that way you'll be able to at least know about all the little perks and promos that we're going to be throwing down the pipe, literally, like just throwing them. Okay, so just make sure you do that. And then if you like what you heard tonight, please share, help people to stop suffering silently, and then be their superhero so they can come back and thank you for helping them get out of the pit that they made for themselves. All right, so that's all I got, guys. Make sure you go to Facebook too at This Gal Talks Credit. Follow me there because that's where I'm doing mostly all my lives now. That's This Gal Talks Credit. And I'm hoping that I'll see you guys again, but I needed to make sure I got on tonight to release my conscience, feel good, go to sleep easily, and rest peacefully. So hopefully, again, I will see you on the next live, and I thank you so much for chiming in. Thank you, thank you, thank you, and I'll talk to you guys hopefully tomorrow, because it's tomorrow here already. Have a good evening, everyone. I'll talk to you soon. Bye.